the audio reporting of the luxury retail market. Imagine a brand dropping almost $1 billion on a single building just to sell handbags.
I mean, it sounds like a hypothetical scenario, right?
Right, exactly. But it isn't. That is exactly what is happening on New York's Fifth Avenue right now, and it really fundamentally changes everything we thought we knew about how the world's most exclusive products are sold.
Yeah, it really does. And that's why today we're taking you into a special deep dive into a newly comprehensive 6-chapter research series.
Yeah, the series is titled The Structural Realignment of Luxury Retail and Commercial Real Estate.
And the architecture of this LRM series is honestly vast. I mean, we're looking at a preface, a foreword, a prologue, chapters 1 through 6, and an epilogue.
Right. It's a massive undertaking. And if you are following along with the research at home, the preface, the foreword, the prologue, and chapter 1, which focuses on Beverly Hills and the greater Southern California market, those are already published.
Exactly.
Yeah.
And just to give credit where it's due, leading this exhaustive series is Robert Gutierrez Jr., a researcher and the founder of LRM.
Yeah, and we also have these incredible foundational insights from Ashley, an LRM contributor and global luxury real estate strategist. She actually wrote the foreword.
She did, yeah. So our mission for this deep dive is basically to give you a broad street-level overview of the massive shifts happening right now in the luxury retail industry and, its commercial real estate segment.
Right, so we're going to unpack the reports that are already out there and explore the upcoming architectural battlegrounds in places like San Francisco, Chicago, Dallas, New York City, and Miami.
It's going to be a lot to cover, but it's so fascinating.
It really is. Usually when we talk about a massive blockbuster movie franchise, there's a pretty predictable formula. For years, the studios just crank up the CGI, they raise the ticket prices at the multiplex, and the fans just line up to watch.
Right, they just print money.
Exactly. But eventually, the fans get exhausted. The spectacle alone just isn't enough anymore, and the studio realizes they actually have to return to good storytelling and, true substance to win back a tired pace.
That is actually the perfect analogy for what's happening. That identical pivot is hitting the global luxury retail market right now. The research actually calls it the end of the super cycle.
The super cycle. So talk to me about that, because that term gets thrown around a lot.
Yeah, so looking at the period from basically 2019 to 2023, the luxury sector experienced this historic, relentless era of growth.
Right.
And this super cycle was driven almost entirely by scale and aggressive, just continuous price hikes. Brands were essentially testing the ceiling of what consumers would tolerate for entry-level luxury goods.
It's like pushing to see when people would finally say, okay, that's too expensive.
Exactly. They were effectively relying on inflation and momentum rather than fundamental product innovation. But that era of easy momentum is firmly over.
Wow. Okay, so what comes next?
Well, we are now entering a profound recalibration phase. Going into 2025 and 2026, the industry is looking at low single-digit growth.
That is a huge drop-off.
It is. Brands are facing severe tariff turbulence, complex macroeconomic headwinds, and a very real consumer pushback against prices that, mimic inflation without actually delivering proportional quality.
Yeah, I mean, people aren't stupid, but that tariff turbulence and consumer pushback isn't hitting everyone equally, though, right?
No, not at all. The geography of where people buy luxury is fundamentally breaking down.
Right, because the United States continues to be a critical bright spot. I know there has been a slight deceleration in retail spending recently, specifically in categories like bags and apparel over the late summer.
Yeah, a slight dip.
But overall, the U.S. remains the primary target for European heritage brands deploying aggressive capital reinvestment. The picture shifts drastically, though, when we look across the Atlantic to Europe or, over to Asia.
Yeah. All right, let's look at Europe first. So the market there is suffering from weaker tourist spending, which is inextricably tied to the mechanics of foreign exchange fluctuations.
The currency exchange rates.
Exactly. Traditionally, wealthy American tourists flocked to Paris or Milan because a strong U.S. dollar made luxury goods significantly cheaper over there.
Oh, right. The classic European shopping spree. It relied on a price differential of what, about 26%?
Yeah, around 26%. A buyer could easily justify a transatlantic flight because the savings on a few high-end items would literally cover the cost of the trip.
Right, like buy a few bags and the business class flight pays for itself.
Exactly.
Yeah.
But with the U.S. dollar weakening recently, that discount has shrunk to around 20%.
Which doesn't sound like a massive drop, but
Psychologically and financially, it entirely alters consumer behavior. The arbitrage simply doesn't cover the business class ticket anymore, making the overseas flight far less appealing for a dedicated shopping trip.
That makes total sense. Meanwhile, China used to be the ultimate growth engine for these brands, right? Like the place where double-digit growth was virtually guaranteed every single quarter.
Yeah, they were the golden goose. But we're witnessing a structural evolution in consumer taste over there right now. High net worth individuals in China are shifting heavily toward quiet luxury.
Quiet luxury, so moving away from the big logos.
Exactly. They are moving away from ostentatious, logo-heavy branding and prioritizing understated style and experiential purchases.
Interesting.
And because of this maturation in the market and a cooling broader economy, overall luxury sales in China are expected to be broadly flat going into 2026.
So if the macro environment is tightened globally and the consumer is getting, far more cautious, how are these brands adapting their physical stores to attract them? I mean, you'd think they might shrink their footprint or retreat to save capital.
You would think so, yeah. But the answer is completely counterintuitive. They are polarizing their retail formats into what analysts call a barbell strategy.
A barbell strategy. Okay, break that down for me.
So they are rapidly abandoning the uniform mid-sized boutique in favor of two extreme opposites. On one end of the strategic spectrum, you have the mega-flagship.
Right, the temples. We're talking about monumental, awe-inspiring buildings that span like 50,000 to 100,000 square feet.
Exactly. Look at the upcoming Louis Vuitton space in Beverly Hills, which is designed by architects like Frank Gehry and Peter Marino.
Or look at Hermes. They executed a record-breaking $400 million real estate deal on Rodeo Drive just to acquire the dirt. Literally just the land to build what could become their largest store in the entire world.
Yeah, $400 million for the land. It's staggering. And we see this same hyper-growth phenomenon playing out in South Florida, which will be heavily detailed in Chapter 6 of the LRM series.
Oh, Miami, right.
Yeah. The Miami Design District has completely transformed from a neglected enclave of furniture warehouses into a $4 billion luxury powerhouse. The area is seeing an explosive 67% year-over-year rent surge, firmly establishing the district among the nation's most expensive retail streets.
But why are they willing to pay those exorbitant premiums?
Because these mega-flagships serve a very specific volume-driven purpose. They act as architectural billboards and highly visible entry points for aspirational shoppers.
Oh, it's about foot traffic.
Exactly. They feature permanent museum exhibitions, bespoke cafes, rooftop restaurants. This is where the sheer traffic happens, the people coming in to buy cosmetics, fragrances, or, small leather goods.
Right, so that is the loud, proud, massive temple on one end of the barbell. But on the other end, you have the private exclusive salon.
The secret store.
Essentially, yeah, a secret store. This is an environment built for extreme privacy, strictly for very important clients or VICs.
And this exists because of the Pareto distribution of luxury profitability. A disproportionately minuscule percentage of top-tier clients generate the overwhelming majority of a brand's net profits.
Like the 80-20 rule, but probably even more extreme.
Very extreme. And those ultra-high net worth individuals do not want to wait in a line around the block with tourists outside the mega flagship.
Definitely not. As entry-level prices have skyrocketed, these top-tier clients demand environments that provide, total isolation, bespoke curation, and an aura of absolute exclusivity.
Right. Brands are building spaces like Casa Cucinelli, which are gorgeous residential-style Italian lofts featuring imported wines, private libraries, and full kitchen suites.
They sound like private clubs.
Basically, they're designed to host intimate cultural events entirely away from the public eye.
And it's not just the European heritage brands doing this. Even legacy department stores are transitioning to this model. Like Saks Fifth Avenue launched their Fifth Avenue Club, partnering with ultra-luxury hotel flags like the St. Regis and the Ritz-Carlton.
Right, so you don't even go to the store.
Exactly. You don't even go to the traditional retail floor anymore. You go to a private hotel suite to shop, bypassing the friction, the crowds, and honestly, the severe theft concerns of a traditional store. We also see this with Catherine Bloom for Nordstrom in Los Angeles. It basically operates like an appointment-only clubhouse where elite clients literally fly in via private jet for highly sought-after pieces completely unavailable to the general public.
And we're going to see this concept explored deeply in Chapter 4 of the series, focusing on Dallas.
Right, Highland Park Village.
Exactly. It's America's first self-contained shopping center, and it has evolved into a literal fortress of luxury. It exhibits immense pricing power and zero functional vacancy, capturing the highly concentrated purchasing power of Dallas's corporate elite.
By offering an isolated, ultra-secure ecosystem that feels entirely separate from standard retail.
Precisely.
I have to push back here, though, admitting my own confusion.
Sure.
Isn't this essentially creating a caste system in physical retail? Like, you have the crowded mega flagship for the Instagram tourists and the hidden velvet rope salon for the actual buyers.
That's a fair point.
Doesn't this dilute the core brand illusion for the everyday shopper? Doesn't it ruin the magic if you know you aren't in the real store? I mean, even if you aren't shopping for a $10,000 bag, you should care about this, because this barbell strategy is trickling down to your local mall, segmenting how everyday consumers are treated based on data profiles.
That captures the exact tension these brands are navigating right now. Because, over the last decade, luxury brands aggressively expanded their physical footprints to drive volume.
Right.
They democratized their products to the point where they diluted the true historical markers of luxury, scarcity, and intimacy.
Ah, so this is a course correction.
Exactly. The barbell strategy is their attempt to correct that overexposure. They desperately need the massive revenue from the aspirational buyers at the flagship to fund their operations, but they must use the private salons to shield their brand equity and cater to the ultra-wealthy who actually drive the reliable profit margins.
Okay, that makes sense. But to build these dual worlds, especially those massive mega flagships acting as architectural billboards, you need absolute control of the building, right? Absolute control. You can't just be a tenant hoping the landlord fixes the roof or allows you to punch a hole through 3 floors to build a sculptural staircase.
No, definitely not.
And this brings us to the commercial real estate war. Historically, the luxury industry operated on an asset-light philosophy. You lease the space, you maintain capital fluidity, and you stay agile.
Because why own the building when your business is selling shoes and handbags?
Right. But today, the macroeconomic climate has made leasing a severe liability.
Rents are astronomical. We were looking at Fifth Avenue in New York commanding $3,500 per square foot.
Oh my God.
And Rodeo Drive is hitting $1,120 per square foot. If you are building a multi-story temple with integrated hospitality and museum-grade curation, you cannot be at the mercy of exorbitant rent hikes or inconsistent landlord maintenance.
So brands are aggressively transitioning to property ownership.
Okay.
Think of it like renting an apartment versus buying the whole building. Instead of worrying about a landlord jacking up the price every year and eating into your profit margins, these conglomerates are buying the building to lock in their costs forever.
Right. It converts a perpetual operating liability into a capitalized appreciating asset.
It acts as a structural hedge against localized inflation. But tying up billions of dollars in real estate puts an incredible strain on corporate liquidity, doesn't it?
It does. And this is where we are seeing a wave of highly sophisticated financial engineering.
Okay, let's look at Kering's recent landscape-altering transaction on New York's Fifth Avenue, which, by the way, will be a major focus of Chapter 5.
Yes, the 715 Fifth Avenue deal.
Right. So Kering, the conglomerate behind Gucci and Balenciaga, they bought a massive retail asset at 715 to 717 Fifth Avenue for an astonishing $963 million.
Almost $1 billion for one building.
Almost $1 billion. But they didn't just sit on that massive debt, though. They immediately formed a joint venture with a global private investment firm called Ardian.
Ah, so they split it.
Yeah, Kering sold a 60% majority equity stake to Ardian for $690 million.
That's brilliant.
It is. They instantly monetized the real estate, got a huge chunk of their cash back to fund other operations, but by retaining a 40% equity stake, they secured permanent, multi-decade control of that ultra-prime location.
And private equity firms like Ardian, they want that 60% stake. Because ultra-prime luxury real estate on Fifth Avenue acts like a blue-chip bond with a built-in luxury tenant providing a totally safe yield.
Right.
It is a brilliant blend of private equity tactics and localized retail strategy. And Madison Avenue is experiencing a similar powerful renaissance, with rental growth exceeding 8% year over year as brands scramble to secure controlled footprints.
Which ties perfectly into what Ashley wrote in the foreword of the LRM series. She noted that when you are inside the room making these portfolio decisions, leverage isn't just a function of how famous your brand is.
Right, it's about relationships.
Exactly. It is equally a function of relationship continuity, institutional reputation, and a track record of following through. Landlords extend their best opportunities to partners whose word closes deals rather than reopens them.
That's a great point. Physical presence has become the most permanent statement a brand can make. Capital used to simply follow growth charts, but the groups that command the most respect today are the ones moving with absolute conviction.
You either move with intention and define the block, or someone else defines it for you.
Exactly, and we see this exact dynamic playing out in Chapter Three's analysis of Chicago.
Oh, the Midwest bifurcation?
Yeah, the Midwest is bifurcating. The iconic Magnificent Mile is transitioning toward large experiential recovery, but ultra-luxury capital is fleeing to adjacent Oak Street, which is commanding $400 per square foot.
Because brands want smaller, hyper-controlled footprints or distinct ownership there, rather than massive leased spaces on the Mag Mile.
Right. And we also see this in Chapter 2, looking at Northern California. San Francisco's Union Square is attempting stabilization by navigating well-publicized civic challenges, contrasted against the massive capture of tech-generated liquidity down in Silicon Valley at the Stanford Shopping Center.
Where brands are establishing fortified, heavily controlled environments.
Exactly.
But, securing the best real estate in the world and owning the corner of Fifth Avenue means absolutely nothing if your brand's cultural resonance is dead.
Right. If nobody wants to walk through the doors, it's just an empty, expensive building.
Exactly. So how are these brands engaging the modern consumer, what the research calls the cultural pioneer, to actually get them into these newly acquired stores? First, they have to address a massive trust deficit.
Trust is totally broken right now. Consumers today are hyper-aware of value and longevity. The old dream world built on exclusivity and artificial hype is crumbling.
People want things that last.
Exactly. And this has led directly to a monumental boom in what the industry calls hard luxury, fine jewelry and watches. Hard luxury is expected to be the fastest-growing category, expanding at more than 4 times the rate of standard clothing, fundamentally because it prioritizes wealth-preserving investments over transient seasonal trends.
The sources mention something called the real effect, which absolutely blew my mind.
Oh, yeah, this is fascinating.
Consumers are literally calling the luxury resale platform the real while standing on the floor of a primary boutique. They want to check the secondary resale value of a Goyard tote bag before they buy it brand new.
Yeah, it's wild. The mechanism driving this is the normalization of luxury goods as an alternative asset class in personal finance.
Right. People aren't just buying a bag, they're managing a diversified portfolio that happens to sit in their closet.
Exactly. Knowledge is the new currency, and how that knowledge is communicated has entirely shifted.
Because the old rule of luxury was to hire a massive global celebrity to create aspiration. The new cultural rule is to partner with niche creators to provide entertainment.
The data shows people are increasingly bored by traditional global celebrities posing beautifully with a product. The playbook has shifted toward creators because relatability and entertainment build much deeper inroads into specific, highly engaged communities than a traditional celebrity billboard ever could.
Which is such a massive shift from, a traditional Hollywood star. And this creator-led dynamic leads to another major shift. Brand narratives are becoming open source.
Open source, yeah. Historically, a brand dictated its narrative top-down. They published an ad and you consumed it.
Right.
Today, a brand's world is built by the community. Fans who have never even purchased a single item from the brand a Leon Dor will share the brand's lookbook images on their Instagram mood boards, entirely propelling the brand's lore and cultural relevance for free.
Balenciaga is a prime example of this, too. One of their most hyped cultural moments recently wasn't created by their marketing department.
No, it wasn't.
It was a Harry Potter AI-generated parody video made by a fan, just a creator on the internet.
Right. The brand provides the visual codes, the aesthetics, and the vibe, but the internet repackages them into memes, starter packs, and viral videos. You aren't just selling physical products anymore. You are selling visual references that build the cult of your brand.
So we have covered the end of the supercycle, the barbell strategy of mega-flagships and secret salons, the multi-billion-dollar real estate wars, and these new open-source cultural rules.
We've covered a lot of ground.
We have. But before we wrap up today's deep dive, I want to leave you with one final mind-bending concept from the research that we haven't even touched on yet.
Oh, this is the part that feels like science fiction.
It really does. The rise of the AI shopper.
Yeah. The technological shift toward agentic commerce is going to disrupt literally every physical and digital touchpoint we just discussed.
The LRM report forecasts that by 2026, autonomous algorithmic agents will monitor global pricing discrepancies, assess limited edition product availability, and execute immediate purchases on behalf of time-poor, ultra-high net worth clients.
And we are not just talking about bot scraping websites here.
No, these are personalized AI agents programmed with your exact sizing, your aesthetic preferences, and your maximum bid operating in milliseconds when a limited edition drop happens.
It's wild to think about.
Which leaves us with this really provocative thought. If the ultimate luxury buyer is actually just a piece of code, how does a brand design a physical, emotional retail experience for an algorithm? Just like our blockbuster movie franchise analogy earlier, how do you impress the audience when the audience is a machine? This LRM audio report was written and produced by Robert Gutierrez Jr., a researcher and strategist at Luxury Retail Market. For deeper research, independent analysis, and long-form insights on the luxury retail industry, visit luxuryretailmarket.org. Subscribe to the show and consider supporting our mission of advancing the future of luxury retail through education, research, and collaboration. Until next time, stay curious, stay informed.